In the middle of 2025, there are ongoing debates about the usefulness and credibility of the modern monetary theory. Both the supportive and the opposing arguments are rather extreme. Those who support the theory argue that the state can go indebted in its own currency without any limits, hence, work guarantee programs and strong social welfare systems are possible. Those who counter-argue the theory do not just deny that unlimited indebtedness would be possible, but even emphasize that the modern monetary theory is not even a theory. Why can we still believe that the modern monetary theory will have a significant role in the future economic upswing? First and foremost, it is important to emphasize that the key innovation of the modern monetary theory is not entirely a theory indeed. It is the emphasis on the funding of the government debt. Regarding this angle, however, they argue that the government can take on debts in its own currency without limits. The debts do not have to be repaid because it is possible to take on new debt to fund any loan obligations. Second, as the Keynesian school suggests, governments have to do everything to achieve full employment. In these efforts, the governments can offer jobs as a final resolution for unemployment. And because governments can take on loans without limits, full employment is indeed possible. During the 2016 American election campaign, Bernie Sanders proposed a single-pay Medicare for all healthcare system. Later, in 2018, he supplemented his former economic plan with a government-provided job guarantee program too. His economic advisor was Stephanie Kelton, a prominent figure of the modern monetary theory. Kelton herself published many papers about the theory and also a book in 2020, The Deficit Myth. The question is whether these policies are possible economically with special focus on the unlimited indebtedness argument. Strangely enough, economists could not reach a consensus regarding the limits of indebtedness. Although there was a non-peer-reviewed paper by Carmen Reinhardt and Kenneth Rogoff in 2009 that argued that beyond 90% per GDP indebtedness, debts are damaging economic growth, their argument is no longer valid by the mid-2020s. As Thomas Herndon, Michael Ash and Robert Pollin pointed out in 2013, the underlying data in the Reinhardt and Rogoff paper did not confirm the authors' conclusions, and their paper had methodological and computational errors too. Furthermore, the promoters of the modern monetary theory could argue that during the 2010s, the growth in the United States was unharmed by the increasing government debt levels. In 2010, American debt was 13.5 trillion, while in 2020 it was 26.95 trillion. By 2025, the debt has grown to more than 36 trillion. In terms of debt per GDP, in 2010 the American debt level was 60%, while in 2025 it is more than 126%. One of the critics of the modern monetary theory, Jim Rickards, raised the point of a psychological barrier to increasing national debt levels. Rickards believes that after a point the public will likely have zero tolerance for further debt increases simply because people just don't want to see such a large proportion of the GDP spent on debt obligations. Unfortunately, there is no empirical data regarding this hypothetical barrier. Nevertheless, it may vary country by country. In Japan, for example, the debt to GDP ratio is already above 200% and Japan is still well, no sign of crisis. However, in other countries, society might not be the same comfortable with such high level of debt. For example, intellectuals in New Zealand are already talking historically about debt doomsday because the debt to GDP ratio in the country is inching towards 50%. One thing appears crucial here. We don't think anybody wants to test this hypothesis by Rickards. In other words, we will not find a country that intends to go into debt so much so that the society would refuse to increase indebtedness any further by organizing strikes and protests. Regardless of the level of indebtedness, in general, when the level of indebtedness is rising, the financial risks are rising too. A more indebted country has to pay higher interest rates. With higher interest rates, when a government decides to print money to stimulate the economy, a higher portion of the newly issued money should be spent on interest obligations, so the efficacy of money printing is decreasing. In earlier clips we called this phenomenon the reduction of the fiscal multiplier. Besides, the job guarantee programs have their own problems too, which lead us to another strong limitations of growing indebtedness, namely the risks of inflation. If a government initiates a job guarantee program, these jobs would be the lowest paying jobs. Firms will have to offer higher wages to workers if they want to attract them from these guaranteed jobs where productivity would be the lowest. Even if these programs can manifest, there is a technical problem as well. When a new unemployed person appears to get a guaranteed job, the guaranteed job should be offered at the same place where the unemployed person lives, and the job should match the person's qualifications. These are structural constraints of employment. If market-oriented firms regularly reproduce structural unemployment, why would we expect the government to effectively overhaul this problem, what the market could not resolve? And last but not least, let's discuss why the risks of inflation appears. Consider a closed economy where the level of GDP is $100 and there is 5% unemployment. The government decides to initiate a job guarantee program to provide employment to the 5% unemployed. For the sake of simplicity, suppose that at the beginning there is no interest payment obligation. Because 95% of the working age population creates $100, the GDP per worker ratio is 100 per 95, that equals $1.05 per worker. If the government intends to pay the average wage to the 5% unemployed persons, they should initiate a program of 5 times this value, which is $5.26 stimulus. The government needs to issue this amount of new money. The country's GDP will increase to $105.26 in real terms. However, will prices remain the same? This is where the commercial bank's money multiplication process comes into play. The freshly issued $5.26 will appear on bank deposits. If the cash reserve rate is 20%, then commercial banks can reloan 80% of the new money, and this process repeats itself in a diminishing scale. Altogether, owing to the money multiplication effect, there will be 1/20%, namely 5 times more money in the economy what the government issued. If the circulation speed of money remains the same, therefore $126.31 worth of money will chase $105.26 worth of goods. This will cause a 20% inflation in that year. The inflation appears because there are no reserve capacities in the economy. The job guarantee program sucked out all unemployed workers. In reality, the math is not this simple because the additional money might end up pushing up asset prices and not the prices of consumer goods. Increasing asset prices, however, in the long run will result in increasing consumer prices too, simply because investors have to price in the more expensive asset costs into their business operations. If governments do not want to risk inflation, they can decide to apply a smaller sized stimulus. If they trust that reducing unemployment directly by 1% is manageable by starting a new government service, then the economy might create employment opportunities for the remaining 4% of workers. The money multiplication process could serve as a tool to achieve this. Nevertheless, it is uncertain. Investors might not see profitable business opportunities, even though they might explore new markets. It can indeed be possible by relaxing the initial assumption of a closed economy. These options are still unpredictable. Earlier, we mentioned Jim Ricard's argument about the likely psychological limits of indebtedness. Regarding inflation, there were a social experience already that showed that the general public does not tolerate quick, double-digit inflation. By the early 1980s, societies got exhausted by the decade-long stagnation and relatively high inflation caused by the oil shocks in 1973 and 1979. They favored governments that promised to contain inflation. Therefore, we already have the evidence that societies would not want the quick inflation rates that might be caused by the recommendations of the modern monetary theory. As we see in the stylized example, what options remain for governments are the same what we see in recent years: shy attempts to stimulate economic growth. Considering all these constraints, the proponents of the modern monetary theory admit that governments' most important economic goals are managing inflationary pressures and resource allocations to achieve optimal output. Practically, there is no magic trick that the approach of the modern monetary theory could recommend. Still, there is a reason why we can believe the modern monetary theory has a significant historic role. After the early 1980s, governments established independent central banks with strong mandates to contain inflation. Typically, these central banks have a target of containing inflation within a narrow band between 0 and 2%, or between 1% and 3%. These bands might be too narrow and they do not allow higher but still moderate inflation, with which unemployment could be decreased more efficiently. The proponents of modern monetary policy will hopefully achieve that political parties would think differently about inflation, and they would prefer the reduction of unemployment as more important than containing inflation in such a strict band. What is wrong after all with a situation where inflation is 4 or 5% during an extensive period but unemployment is 2 or 3% lower than before? The proponents of the modern monetary theory might hopefully achieve that political parties would think differently about inflation and would prefer the reduction of unemployment as more important than containing inflation in such a strict band. What is wrong after all with a situation where inflation is 4 or 5% during an extensive period, but unemployment is 2 or 3% lower than before?